Today we're going to cover a subject which has recently come up in client conversations, and they are addressing questions which are common whether you are an existing client or you're a prospective client for a financial advisor. Wherever you go in the world, you're going to be asked questions about how you feel and think about the market. My name's Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
Even if you're an independent advisor and you are going online to open up your account, whether you're seeking a lot of help or a little help, you're going to run into a financial suitability or risk evaluation questionnaire, typically anywhere between 10 and 20 questions. How old are you? How soon are you going to retire? How much do you have now to invest? And what do you think you need in the way of income when you do retire? What happens to your reaction if the market drops by 5% or 10 or 20? What are you going to do when these things happen? That's a series of questions which have a great deal of commonality, even if they're phrased a little differently. And what's the purpose of this? Since everybody's asking it, it's kind of an industry standard. It's standard operating procedure, if you will, to open up an account. Even if you're an independent advisor, your answers to these questions are critical to the way your portfolio is going to be structured.
It is, and most of those risk return questionnaires are written specifically to get most people to come down right in the middle. Oh, what do you know? Surprise, surprise! You're a moderate investor, and that's where they wanted you to begin with. And so, some of the more conservative and more extremely aggressive questions are couched to get you to not choose them because they want you right dead in the middle, and they want you to say that because instead of the investment advisor interviewing you and then saying you need to be very conservative or you can be significantly more aggressive, they want you to make that decision. So they're just going to hand you that paper, wait for you to answer the questions, and then they're going to put it into their little calculating process they have afterwards, and it's going to spit out usually a 1 through 6 number for you. That's the portfolio you're going to be in, and chances are really good you're going to be in a 3 or a 4, and that's about it. And that's where they want you.
That's a balanced portfolio. And while you're talking about that, it reminds me of what happened in the aftermarket of 08. I had a client at the time who we had been working with for several years and periodically go through that same risk questionnaire. And she was in a balanced portfolio. It was that number 3-4 model. Well, then the market fell apart in the last quarter of 2008 with the housing debacle and all the fake mortgages and stuff.
Boy, that was a good time, wasn't it?
That kept us awake. And everything seemed to be going fairly well until November, December, and the first quarter of 09, and the whole world seemed to be falling apart. And the Fed was having to bail out banks. I mean, we found there was mortgage fraud. Who would ever think that fraud would be a prevalent problem?
Yeah.
But here it is on a different issue, but it's back in the news today. So even though we were using the risk guidance and we were using professional management companies, Wall Street firms who had said, this is the way that you set up a client portfolio, how you determine which portfolio is appropriate or suitable for that client. And that's kind of how we've got this subject today, because in one of my conversations today in discussing portfolio alternatives with a client, his answer was, well, is this really suitable? So we're thinking, well, yeah, well, what's suitable? So how do we get to suitable? The industry's doing this process and everybody ends up in a 3-4 balance model. Is that suitable for everybody? Well, the problem in 08 was that even using that institutional model and guidance, her portfolio went down. And she came in and said, you should never have had me in this portfolio. I said, well, let's go through the risk questionnaire again to see. And so her answers didn't change. And as you just mentioned a moment ago, Perry, The scoring of those answers didn't change. Nothing had changed about how important answer A was over B or C or D or E. But the score was the same. I said, no, we're in the right place. We just need to stay here. Well, I don't want to stay here because I'm down. I mean, basically, she said, you're not supposed to let my account go down. And she fired us. Not that day, but within within a couple of weeks, she had found another advisor who I know asked her the similar questions, but he got to start with a new lower benchmark. So here's the underlying question. What is really suitable if you're going to invest in the stock market? Well, what's suitable are things that go up, not things that go down. And you're saying, well, duh, that's why I came to you. I want to buy stuff that goes up. But the whole risk management process is to find a balance between the things that are working in the current market and the things that aren't working. And on balance, we should reach a level that is emotionally acceptable to you. Now, listen carefully. Emotionally acceptable to you. And the client assumes that if we can find that portfolio, I will achieve my financial goals. But that's not a given. First of all, the models aren't predictive. And secondly, in order to reduce emotional irrationality, you have to reduce risk exposure, which means you remove the percentage of risk assets, which means you remove return potential. The more concerned you are about how you respond to market risk, the less likely you're going to achieve your financial goals.
Yeah, and if you read that risk return questionnaire, there's not a single question in any one I've ever seen that says, is this portfolio decision going to allow me to reach my goals? Or does the advisor think it is? Or does the client believe it's going to let them meet their goals? That's not part of what the risk exposure questionnaire is all about. It's just to get a reading on how the client feels about losing money, because everybody feels great about making money. It's how do you feel about losing money? And that's all that is. That's all that entire form is built to try to determine. And it's to help the advisor down the line, if things go sideways, keep you in the account. It's like, well, you said this was okay, so that's what we did. And so that's not us. That was your decision. You know, you chose those answers. Those are your answers, not mine. And it's to give the advisor an out. And that's not really what anybody thinks that means. That's not what anyone thinks that risk return questionnaire determines. They think it determines how much risk their portfolio is taking. And that changes daily in the market. It really has nothing to do with that. It's 99% about feelings and nothing else.
And one of the ways that's handled is by diversification. If we put more diversification in your account, then we reduce the probable volatility on the account. But that, in fact, is self-defeating. Recent research analyst, a professor at Arizona State University, published a report looking at the S&P 500 since 1926 and determined that 4% of the stocks in the S&P 500 actually generate all of the return. The other 96% of the stocks basically didn't do any better than owning treasury bills. So when we diversify, we are creating significant drag on return. But diversification is another one of those mantras that everybody accepts as gospel. Well, I must be diversified in order to have a properly managed account. Well, yes, there is a limit to that. And there is research that goes back into, academic research goes back into at least the 70s that I'm aware of, that says if you're dealing with a stock portfolio, individual stock issues, if you have a portfolio around 20 stocks, you can manage the risk of that portfolio. The issue really is single stock risk, and you can manage that. Most of that research is done over buy and hold strategies.
Sure.
Basically, you can't ignore a company even if you're going to hold it long term. You shouldn't hold it long term without paying some attention to it. But what's more significant, if you're paying attention on an active basis, when things start to go sideways, you just simply get them out of the portfolio. That's active risk management. It has nothing to do with how you feel about it. We've said this for years. You marry your spouse for better or worse, richer and poorer, health and sickness. But with your stocks in your portfolio, they're a tool to achieve a goal, and you should not be married to an individual stock because you can go through long periods of time where it's a drag on your portfolio.
And like you said, Don, the stocks don't care how you feel about it. At that point, it doesn't matter how you answer the questions. It doesn't matter if you said, hey, if I lose 20%, I'm fine. It doesn't matter how disturbed you are or are not. Stocks move up, stocks move down, and that the assessment of whether it belongs in your portfolio and whether there's an appropriate amount of risk for you as a client is completely based on how that security is doing in relation to everything else that's available, and how much money you have, how much time do your investments have to work? What's your current window for investing? How long do you have to let that money work? Those are the things that are important, not how worried are you at night. That really isn't part of the question. That really isn't part of, especially the solution as to what should or should not be in your portfolio. How you feel about it doesn't really matter. The market doesn't care what you think. The market doesn't care what you're worried about. The only person that cares is your advisor and yourself, and those decisions need to be made based on dollars and cents and market trends and not emotions.
So every market goes through cycles. The economy goes through cycles. We have good times, we have bad times. We have them within the country, we have them around the world. When you look at what's happening in the economy, different stages of economic growth or recession benefit different sectors of industry. So when you have a growing economy, your stock portfolio should be focused on those sectors that do well during growth stages. During recessions, you should be concentrated in those sectors that do well during contracting economies. But that's not what happens when you answer a risk questionnaire. You get a little bit of everything. And if you say, well, I'm not doing all that well, you say, yes, but you have this stuff and it's doing well right now. These other sectors that aren't doing so well, they will the next time the economy turns up or down, depending on where you are and you ask the question.
Sure.
What's more important from our position is a dynamic portfolio that is looking for sector leadership, stays concentrated in sector leadership as it rotates through the economic cycle, and within those sectors, concentrates on the leading stocks within the sector. So now you can have an actual stock portfolio that responds to the economy in real time. And the issue is, can you make money doing that? If you're making money, your fears go away. The fears come when you see half of your portfolio is dragging along the ground and keeping you from getting where you want to be. Especially if you assume the questions that you gave your advisor were going to accomplish your objective. The one thing you didn't quite get to, Perry, when you're talking about the structure of these questionnaires is, why do they really exist? And they exist to transfer responsibility for underperformance to the client and protect the firm from liability if things go bad enough that they get sued by the client. But the first defense is, but didn't you answer these questions? Aren't these your answers? Well, according to academic theory, these questions lead to this portfolio, and this portfolio in this economy is doing just what it's supposed to do.
So it's not our fault. That's the main thing to the advisor. Yeah, it's not our fault to the firm. And that's quite frankly not good enough. Like I said, Don, you need to evaluate where your portfolio is in relation to what's going on in the economy. And the portfolio needs to change based on, are we in a recession? Are we in a period of high growth? It's a different set of securities you should own. It should never be static. And that's what the risk return questionnaire leads to, a static portfolio. That's not real risk management. Adapting to where the market is, that's how you can mitigate some real risk.
The return differential between using a broadly diversified portfolio structured around a risk questionnaire and actually owning a dynamic portfolio of individual stocks that are focused on leadership and the elimination of laggards is a huge differential. If you want to know how we address that, contact us. Our contact information is here. Subscribe. There's a link right down here on the bottom of the screen somewhere that you can click to subscribe so you don't miss. Go to our website. There's contact information there. We'd be glad to have a free conversation with you, analyze, show you what we're doing, analyze what you're doing, give you a comparison to think about. It's a freebie. It's free time. It's educational. Just give us a call. We'll be glad to spend some time with you. And this is the beginning of a new year. We hope yours is as happy as ours is starting out to be. Have a great day. Stay with us. We'll be back in another podcast.